Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
On the other side of it, as it starts to move in our favor, you'll notice that as we start to drop, in this case we're dropping 1 point at a time here, you'll notice that the put option premium begins to adjust. So on expiration, if we drop from 89.50 to 88.50, then we've in fact seen an appreciation of 100 or $1 on this premium. So we're still at a loss, but at the same time, you can see that we still keep that 150 that we sold because we actually sold the 86s. And so until this underlying drops below 86, this premium is going to expire worthless. So we're down 180 on the original put, but we still keep the 150 from the short put option. Our net loss is 30. As it continues to move in our favor, on expiration, if we're down at 87.50, okay, we're at a loss on the 89.50 put based on what we paid of $80, but we keep that 150 still. So now for that entire position, we're up $70. And you can see that as the underlying continues to move down, which is the anticipated direction that we're trading, you can see that the June put continues to increase in value, whereas provided that the underlying is trading at this 86 strike on expiration, we will recognize our entire profit, which is $220. So our risk is $1.30 to make $2.20. But notice that we can't make any more than that $2.20 because even though the underlying continues to the downside and our long put option is still making money, a short put option is now starting to show some value as well, and that's offsetting our profits over here. So we'll never be able to make any more than the difference between the 89.50 and the 86 strike minus the premium that we've paid, regardless of how low the underlying security goes. So the important thing to consider about these spread strategies is that although you're offsetting the market, the implied volatility of the option contract by selling that out of the money option and collecting the premium, you're also limiting your profit potential. So in this case, you can see that we've limited our risk exposure to $1.30, but we can only make a profit up until the strike price that we sold, which is essentially the 86 strike, and anything beyond that, we stop profiting. Okay, so again, always remember when you lower your cost basis using a debit spread, when you look to offset the cost of an expensive option contract by creating a spread strategy, you also offset the profitability of the position by putting a cap essentially on that position. So when we're using debit spreads, the bottom line is that we're able to reduce the break-even point of the trade. So if we've had to pay a little bit more for the option contract based on implied volatility being relatively high, we can use this debit spread to lower our break-even point and offset some of that expense in buying those options that have a higher implied volatility. The idea is that we also will begin to watch our position profit sooner, because instead of in the example that we just shown where we paid out $2.80 for the put option or $2.60 and having to wait for the underlying to move that much in order for us to be beyond our break even. By selling that additional put option, we've lowered our cost basis, therefore lowering our break even point. We've reduced the, we've reduced the potential loss if we're wrong. So rather than paying an expensive pardon me, rather than paying out that expensive premium and risking that entire amount of capital. What we're doing is we're reducing the amount of capital that we're putting out just in case we're wrong, and our the caveat to that is that we're capping our upside profit. So, guys, recognize, I guess, in summary here, just to kind of wrap things up, that the changes in volatility will have a direct effect on the risk versus reward of any trade that you're looking to implement. And it is important as an options trader to pay attention to what's happening with respect to implied volatility, because if you're overpaying for an option contract, essentially what that means is that there is an anticipated move factored in to that premium, and if that move doesn't take place, then basically we can see that that implied volatility contract, and you can lose money on your premium based on that. So we want to pay attention to what's happening with that implied volatility, and we want to make sure that we're using strategies that complement the current implied volatility that we're looking at on any underlying. We have to make sure that being aware of that will help us be a little bit more proficient at making sure that we're trading the appropriate strategy. I mean, one of the reasons, just looking at it from just a simple options buying perspective, we talk about being cautious when purchasing options around key economic announcements, simply because if you buy your options too close to those announcements, you might be overpaying for them, and ultimately, if the move doesn't take place, you're going to be at a loss because of that contraction. So again, paying attention is going to allow you to take the proper steps to make sure that you're using an appropriate strategy. What we talked about here tonight is, as an option buyer, when it might be appropriate and how it might be appropriate to use certain low volatility situations, and then also how it might be how you might be able to take advantage of circumstances where the security has a high implied volatility. But again, recognize that there are many other strategies, such as credit spreads. So looking at, under periods of high volatility, being that option seller and sort of offsetting the risk as an option seller by creating certain types of debit spreads and such to take advantage of that implied volatility. When the market is not moving and when implied volatility is low, generally speaking, being an option writer is not that attractive. So guys, certainly open to take any questions at this point. Steve, I've pretty much wrapped things up. Not sure if you have any comments or anything that you want to if you want to just sort of bring forth to the folks that are online now. But I think that's it for me.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.